Hi everyone. So today we are going to be looking at CMA Part 2, Section B, in that the second topic in CMA Part 2, Corporate Finance. And we're going to start with risk and return. What is risk? What is return? And at the end, I want to show you how to calculate return and a measure of risk. So this is a fundamental lesson before we handle and tackle a little bit more complicated ones. So from this, the next class we will build on and we will talk about types of risk and capital asset pricing model. But today is very important. So ensure you watch the entirety of the video. At the end, I'm gonna do a couple of samples, couple of problems to calculate return as well as standard deviation or measure of risk. Okay, let's say you have a certain amount of money, $1 million. Let's say you worked in the US, you saved $1 million, and now you want to invest it. So if you want it to be really low risk or no risk, you will go for something like a treasury bill or even a savings account, right? If you are in US, you can go to a PSU bank, deposit with them. Usually it is considered zero risk, at least from an Indian currency. Once you convert the money into Indian currency, it is zero risk. So let's say the bank gives you 3%. We will call that risk-free for our purposes, 3%. So now you are here, you have given the money to the bank at 3%. Now, let's say someone comes and tells you, hey, what are you doing with it? 3%? That is not even going to cover inflation. Why don't you put it in your stock market? Why don't you put the money in the stock market? Okay, so let's say he tells you, put it in the stock market. And now, if I tell you that you will get 3% in the stock market, will you invest your money in stock market? You'll say, no, are you crazy? I'm already getting 3% from the bank. Why would I invest 3% for the stock market? I need more because stock market is very risky. So this is risk-free, the bank investment. But when you are doing stock investment, you are expecting a higher return. We don't know what it is. We will calculate what it is later. But let's assume, are you going to be happy with 4%? Maybe not, right? Let's assume you're going to be happy with 12%. So this higher return is because there is a higher risk. Let's assume one other guy comes and tells you, why stock market? Invest in startups. Become an angel investor. Pick a few startups that you think will be hugely successful. You can make sometimes 100 times your investment. So in that scenario, he tells, hey, you do that, you will get, say, 12%. You're not going to be happy. You are interested because he's saying you can get 100 times. Right? So the expected return has to be higher when we are talking about private investments like VCs, angels, etc. Right? Let's assume it is 25%. So you see, as the risk increases, the expected return also increases. Risk and return are correlated, positively correlated. Higher the risk, the expected return is also high. So this is the first principle, and it is very important, the fundamental in which a lot of the other theories we are going to see is going to be based on. Okay, so now let's talk about risk from an investor standpoint, right? Which one would you choose? Which one would you choose? It depends a lot on your appetite for risk, right? In CMA curriculum, they call it the risk preference. There are three types of investors based on the risk preference. First one is risk averse. Risk averse. So they don't like risk, right? Risk averse. Second type is the risk neutral. And then you have the risk seeking investor. So how do we determine if you are risk averse, risk neutral, or risk seeking? Let's say we have a game, right? There's a coin, there's the heads and the tails, right? And you are going to flip it, and then someone is telling you, okay, if you get heads, you are going to get 200 rupees, 200 Indian rupees. And if you get a tails, you're going to get nothing. You're going to get nothing. Okay. So now, what is the expected return from this coin flip? So when we are going to flip this coin, that is an expected return. How do you calculate the expected return? It is the return times the probability of it happening. The outcomes, the return outcomes times the probability of each of those outcomes happening. So in this case, we said there are only two outcomes, either it is 200 rupees or 0. And the probability of heads happening is 50%, and the probability of tails happening is 50%. So the expected return calculation would be the return times the probability of each outcome. So the return when we get a head times the probability of head occurring, and the return when we get the tails and the probability of the tails, right? Simple. So again, if you do the math, you have 200 rupees, and the probability of that happening, as we said, is 50%. Same thing, 0 into 50%. So this is going to be 0, 200 into 50% is 100. So the expected return is 100, even though it is very volatile. It could be 0 or 200, but from expected return standpoint, it is 100. So if I offer you less than 100, I say I'll give you 10 rupees instead of going for this outcomes. Instead of these outcomes by flipping a coin, I give you 10 rupees instead. Then you say, give me the 10 rupees. I don't want to play this game. Even though you know the expected return is 100, you are risk averse. When you settle for a lower payout compared to the expected return to avoid risk, you are called as a risk averse investor. But on the other hand, you will only take 100 rupees, right? You will only take 100 rupees instead of playing this game, because you know that the expected return is 100. So you're not going to take 10 rupees. You're not going to take 99 rupees also. You will be only happy with 100 rupees. Then you are the risk neutral investor. The risk seeking person is the other way. He will not even take the 100 rupees. He will want something more than 100. Maybe 150 rupees instead of playing this game. Even though it is risky, he wants that risk. He is seeking risk. So for him, it will be more than 100 rupees I have to give instead of playing this game. Whereas, as I said, the risk neutral will he will be indifferent. He will want the exact payout as the game. He's a very rational person, right? The risk averse, on the other hand, is going to be very low on the risk tolerance and will want a lower payout even instead of playing the game. So this will be less than. Alright, so now we are going to pivot into generally calculating return and risk. So we saw the risk preference and how to calculate the expected return. Now if you have invested that $1 million, right, And after a year, so let's assume you invested in the stock market, and after a year, you got back $1,200,000, 1.2 million, right? So what is the return of your investment? How do you calculate it? It's very simple, right? So the return is always over a period of time. So here I gave the example of 1 year. It could have been 2 years as well. So return for the 1 year time period, initial investment, let's call it as I0 at time 0, and the investment after time t, in this case 1, so I0 is the initial investment, and this is the ending value at time t. So IT minus I0, the ending value of the investment minus the initial value gives you what is called as the capital appreciation. So the capital has gained in value this capital appreciation divided by the initial investment is usually the return. But let's assume you invested in the stock market, right? Instead of stocks, they might have also given you some dividend payouts, right? Over the course of the year, you might have also gotten, apart from capital appreciation, some dividends. So that is what we call as an income earned, right? So if it was a bank account, it would be the interest, whereas here, it would be the dividends, right? So ending minus initial gives you the capital appreciation, and then you add the dividend as well, and then you divide the entire thing by the initial investment. So let's take some values as we were saying. So this was 1.2 million minus the 1 million of initial investment, and let's assume the dividend income was 100,000. So 0.1 million, and you divide it by 1 million as well. So you are getting so the return with that investment. So you outperformed the expected returns in the stock market. You made 30%. So the capital appreciation component was 20% and the dividend income component was 10%. So the total return is 30%. So now we have seen the return. Now let's look at risk, right? So when we talk about risk, the most accepted definition of risk is the uncertainty of the return, right? So we are talking about 3%. Is there any uncertainty that you will not get 3%? Pretty much zero. So there is no risk. The risk is zero. That's why we said it's risk-free. Now when I said if you invest in the stock market, you will get 12%, is that certain? No. It could be zero, also it could be negative. It could be obviously, like in this scenario, higher at 30%. So the returns fluctuate. So when there is uncertainty of the outcome, the expected return, then the risk is higher. So we measure that. One of the metric we use to measure that is standard deviation. Standard deviation is a measure of volatility of the outcomes. So the higher the standard deviation, the more wider the outcome ranges. So it means, so in this scenario of coin toss, it's very wide. It could be 0 or 200, even though the mean is 100, right? But it is very wide. What if I tell you in another payoff, you're getting 90 or 110, and the mean is 100? So which is less risky? here my risk is more, I could also get 0, whereas here the outcomes are going to be closer to the mean. The worst case is only 90. So the standard deviation of this game, outcomes of this game, is lower compared to this game. So this is a lower risk play for me. So standard deviation is square root of variance and how you calculate it is pretty straightforward. Each of the outcomes you subtract from the mean and you square it. So you do that for all the outcomes, then you divide by n minus 1, the number of outcomes, and you subtract 1 from it if it's a sample. If it's the entire population, you don't have to do that. But in most scenarios, we are looking at samples. Then you take a square root, right? So you do this for x1 minus, in this case, it is only 2. Or you can write it as summation so this gives you an indication of the risk. Right? This gives you an indication of the risk. As I said, the higher the standard deviation, the wider the outcomes is going to be from the mean, and that is higher risk. Okay, so now we have covered in this class, what is risk, what is return, how is it related, and we also talked about risk preference. As an investor, if you are averse to risk, neutral to risk, and seeker of risk, how does that vary your return versus risk preferences and tolerances? Then we saw how to calculate the return and how typically risk is measured. So in the next class, we are going to look at types of risk, right? So this is just an intro to risk. The next class, we're going to look at types of risk. And once we understand the types of risk, we are then going to look into ways of calculating accepted rate of return for various types of risk. So we're going to be talking about CAPM as well, capital asset pricing model, in the next video. Alright, if you have any questions, leave a comment below. We'll make sure to respond to your doubts.